This morning, someone tried to break silver. They failed. The price opened at $95. Strong momentum. Technical breakout. Then at 9:35, they attacked. Massive sell order. Thousands of contracts dumped in minutes. $95 to $84. $11 drop. Vertical. Every trader watching thought, here we go, the correction, the crash. But it didn't crash. It bounced. $84 held. Buyers stepped in. Physical demand absorbed the dump. By close, $97. Higher than the open. They used their ammunition. They showed their best move, and it failed. The attack proved the opposite of what they intended. It proved demand is stronger than supply. It proved manipulation can't hold anymore. When you dump your entire position and the price closes higher, you're out of options. Ladies and gentlemen, Asian guy here. Let me show you exactly what happened. Minute by minute. 9:30 a.m. Eastern. COMEX silver opens. March contract. 95.20. Volume normal. Momentum bullish. 9:31 a.m. Price ticks to 95.45. Everything normal. 9:32 a.m. Volume spike. Large sell order. Price drops to $94.10. 9:33 a.m. The flood begins. Massive sell orders. Not gradual. A wall of contracts. 92.30, 90.15, 88.40. 9:34 a.m. Acceleration. Every bid gets hit. Every support breaks. 86.20, 85.10, 84.30. 9:35 a.m. Bottom. 84.05. $11 down in 4 minutes. Volume. 45,000 contracts. That's 225 million ounces. 30% of annual global mine supply. Sold in 4 minutes. This wasn't profit taking. This was an attack. Now let me show you who did this, not retail. Retail doesn't move markets like this. Not hedge funds. They scale in and out. This was institutional, coordinated, multiple large sellers executing simultaneously. COMEX data shows the selling came from commercial accounts. The same accounts net short silver for decades. The bullion banks, they saw $95. They saw the breakout. They saw momentum building. And they decided, not today. So they dumped everything, every available contract, every ounce of paper leverage. The goal: create panic, trigger stops, force liquidation, break psychological support, send the message. You cannot win. For 4 minutes, it worked. The price was in free fall. Every technical trader was selling. But then something unexpected happened. The buyers showed up. Let me show you the reversal. 9:35 a.m. Price hits 84.05. Selling peaks. 9:36 a.m. Price stops falling. Sits at 84.10. Small uptick. 9:37 a.m. jumps to 85.30. Large buy order. Then another. Then another. 9:38 a.m. 86.90. Buying accelerates. Someone absorbing every contract. 9:40 a.m. 88.50. Sell pressure gone. 9:45 a.m. $90.20. Price recovered half the drop. On 10 go a.m. $92.10. 3/4 recovered. Noon, 94.30. Almost back to open. 2 og p.m. 96.15. Higher than before attack. Close 4 swing p.m. 97.25. Up $2 from open. Up $13 from low. The day ended green. Higher than it started. As if the attack never happened. Now, let's talk about who the buyers were. Not paper traders. Paper traders were selling. Algorithms were selling. The buyers were physical market participants. Entities that actually need silver. Not to trade, to use. Reports from dealers. During 9:35 to 9:45, phone lines exploded. Large industrial orders pouring in. Manufacturers. What spot? 84. We'll take 500,000 ounces right now. Sovereign buyers. Fill our standing order. All of it. Today. ETF participants. We're creating baskets. We need metal, whatever you have. The physical market saw $84 and said, this is a gift. They jumped in. That buying overwhelmed the paper selling. Because physical buyers weren't selling back. They were taking delivery, pulling metal out. Paper sellers dumped contracts. Physical buyers converted to metal and removed it. Net effect, supply decreased, price recovered, attack failed. Let me show you the technical destruction for shorts. At $95, the short position was uncomfortable but survivable. The crash to $84 was supposed to relieve pressure, let shorts cover at better prices. But it did the opposite. Shorts sold at $84 or $90. Physical buyers absorbed everything. Price rallied to $97. Shorts who sold at $86, hoping for relief, are underwater again. At worse prices, they showed their hand, revealed they have no ammunition above $84, played their ace, got called. The market now knows. Below $85, physical demand is infinite. This establishes a floor, a hard floor backed by real demand, checkbook-ready demand. If $84 is the floor and price closed at $97, that's $13 margin of safety. Room to run. Now the psychology, the signal this sends. Signal 1, suppression is over. Desperate measures signal desperate positions. Signal 2, physical demand is dominant. Paper creates noise. Physical creates direction. Today, physical 1. Signal 3, shorts are trapped. They can crash temporarily, but can't keep it down. Every dip gets bought. For traders watching, this is confirmation. Manipulation era ending. Not because manipulators got moral, not because they ran out of power. You can't hold a beach ball underwater forever. Arms get tired. You let go. It rockets up. Today was the moment the arms got tired. Let me show you the volume analysis. Total volume. 180,000 contracts. 900 million ounces notional, 3 times normal. The selling concentrated, 932 to 935. Massive volume. One direction. The buying distributed, 9:35 to 4 p.m. Steady. Persistent accumulation. Selling was a dump. Buying was absorption. Dumps create crashes. Absorption creates floors. Price recovered and went higher despite that dump. Absorption was larger than dump. More buyers than sellers. Mathematical proof. Market has flipped. Buyers in control. Was this coordinated manipulation? Yes. Obviously, yes. You don't get 45,000 contracts dumped in 4 minutes by accident. You don't create $11 drops organically. This was planned. Executed by entities with deep pockets and coordination. But here's the thing, it doesn't matter. What matters is it failed. Manipulators showed the world their best shot, fired all ammunition. Price ended higher. When manipulation is visible and fails publicly, credibility dies. Trust dies. Fear dies. Traders who were scared saw today and thought, that's all they've got? An $11 dump that recovers? The fear is gone. The respect is gone. The control is gone. Let me show you the options reaction. Before attack, March $100 calls at $2.50. During attack, calls drop to $0.80. By close, calls at $3.10, higher than pre-attack. Options market saying attack was noise, trajectory intact, going higher. And the puts, March $80 puts should have exploded during crash, barely moved. Why? Nobody believes $80 is real. Even during flash crash, put buyers didn't show up. Everyone knows. Below $85, it's getting bought. Options pricing in a floor and removing downside. Set up for squeeze. The dealers. Physical market participants who handled buying. 3 major dealers reported same thing. Phone chaos from 9:35 to 10 pounds. Orders so fast they couldn't process. Clients, buy now, fill at market, whatever it takes. But dealers had a problem. Inventory bought out in 30 minutes. One dealer, we sold a month's worth in the first hour, now back ordered to March. Attack didn't create selling in physical, created buying, depleted inventory, made shortage worse, unintended consequence. Paper dump supposed to scare people, did opposite. Created urgency, historical parallel. March 2020, gold flash crash, it was $700 to $450 in 2 days. Everyone thought, crash, liquidation. Physical buyers stepped in, sovereigns, central banks. By April, gold back at $700. By August, $2,000. Flash crash was the bottom. Attack was signal to buy. Same thing today with silver. Attack to $84 will be remembered as the gift. The moment smart money loaded before real move. Attacks don't happen at tops. Attacks happen when attackers are desperate, trying to prevent something inevitable. Desperate attacks that fail are strongest by signals in market history. What happens next? Shorts just revealed they can't hold below $95. Threw everything at it. Got to $84. Came back. 3 options. Option 1, try again. But they used ammunition today. Don't have more. Option 2, cover. Buy back shorts. Accept loss. But covering at $97 after attacking at $84 is admitting defeat. Option 3, hold and hope. Hope price comes down. Hope demand fades. But hope isn't strategy. Physical buying isn't stopping, it's accelerating. Shorts are trapped. Can't attack without failing again. Can't cover without driving price higher. Can't hold without bleeding. This is endgame. Losing side runs out of moves. Media reaction, or lack of reaction. Bloomberg, silver volatile on profit taking. Reuters, precious metals see intraday swings. CNBC, didn't cover it. No mention of flash crash. No analysis of recovery. No acknowledgement something historic happened. Why? Because acknowledging means acknowledging manipulation, means acknowledging failure, means admitting system is broken. Easier to ignore, call it volatility, move on. But traders saw it, physical buyers saw it, shorts saw it. Today was the day manipulation died. Retail investor question, what do you do? If you sold during crash, you got shaken out, fell for trap. Shorts took your position at $84. Watching it at $97 now. If you held, you survived. Passed the test. Still in game. If you bought the dip, you're a genius. Recognized attack for what it was. A gift. Lesson is clear. Flash crashes in silver are buying opportunities, not selling opportunities. Physical demand is real. Deficit is real. Shortage is real. Paper games create temporary dips. Physical reality creates trend. Trend is up. Global reaction. Shanghai opened 6 hours after crash. Chinese buyers saw $84, went all in. Shanghai premium jumped to $18. London physical, orders pouring. Dealers reporting inventory depletion. Dubai, sovereigns calling. Large blocks, no price sensitivity. Flash crash was New York paper event. Buying response was global physical. Proof that price is wrong. If $84 was fair, why did whole world rush to buy? Because everyone knows $84 is fake. Manipulation level, gift that appears when someone desperate. Gifts don't last. You take them while available. Technical damage, charts after failed attack. Before today, silver uptrend. $95 was resistance. After today, silver broke above $95 and held. Intraday low, $84 becomes support. Everyone who wanted below $85 got filled, not selling. Creates technical setup, higher lows, higher highs. Definition of uptrend. Flash crash, supposed to break trend, did opposite. Confirmed trend by showing demand weights at every dip. Technical traders adjusting. Stops moved up, targets raised, risk reward improved. Failed attack made chart more bullish. Sentiment shift. Before attack, bulls confident but cautious. During attack, panic, fear, doubt. After recovery, euphoria, vindication, confidence. This sentiment shift is fuel. Bulls aren't just holding, adding, recruiting. Spreading word. Bears demoralized, tried best shot, failed. What's left? Sentiment shifting from cautious optimism to aggressive bullishness. Psychological setup for parabolic move. Institutional question. What are big players thinking? Pension funds, sovereign wealth funds, allocators with billions. They watched today, saw dump, saw recovery. Asking analysts, what happened? Analysts telling them, suppression failed. Physical demand overwhelming paper supply, market structure breaking. Institutions deciding, get in now or wait. But waiting has cost. Next dip might not reach $84, might only reach $90, then $95, then no dip. Today was wake-up call for institutional capital. Window closing, cheap entry gone, they're moving. Slowly, quietly, but moving. When institutions move, they move size. Retail buying today, impressive. Institutional buying next week will be overwhelming. Timing matters. Final weeks of 2025, year-end, close of books. Moment when funds rebalance. Flash crash in late December should stick, should create bearish close, should set up January weakness, but didn't stick. Reversed. Closed strong. Signal to allocators. This market is different. Old playbook doesn't work. Manipulation doesn't hold. January historically strong for silver. Entering January with momentum intact, shorts trapped, physical demand screaming, setup is explosive. Today was last chance for shorts to break it before year end. Failed. Now going into new year underwater, exposed, out of ammunition. Final lesson. When they attack and fail, they're done. When they show best move and it doesn't work, nothing left. Today was their best move, $11 in 4 minutes. Maximum pain, maximum fear, and it closed green. That's the moment you know. Confirmation. Manipulation is over, not because they stopped trying, because they tried and failed. Market absorbed attack. Physical demand overwhelmed paper supply. Buyers won. Once buyers win publicly, once everyone sees dumps don't work, psychology shifts. From fear to confidence, from doubt to certainty, from waiting to acting. Failed attack was starting gun, not for crash, for moonshot. This is the day narrative changed. The day charts proved what fundamentals were saying. Silver is in shortage. Physical demand is real. Deficit cannot be solved by paper games. They tried to break it, used ammunition, showed hand, and it closed at $97, higher than it started. The attack failed. The manipulation is over, and price is about to reflect new reality. When you survive the kill shot, you're unstoppable.